So this is chapter 3, this is part 2 of our lecture videos, and we're just following up on an example we did where we were showing that on an accrual basis of accounting, if you have expenses associated with revenues, they must be recorded in the same accounting period, and that's consistent with both the accrual basis of accounting and the matching principle. So in this case, we had 3 weeks of expenses that were necessary to produce that revenue. We recorded revenue of $4,000, which was earned, but we also incurred 3 weeks of expense that was necessary to generate that revenue, and therefore we have to record that expense. Now, we would normally not record that expense until February when it was paid. We'd make an entry at that time, debit, salary expense, credit, cash, something like that. But at this point in time right here, at the end of January, we would have to make an adjusting entry. So our adjusting entry here, an adjusting journal entry at January 31st would be to debit salary expense for $1,500 and to credit salaries payable because we haven't paid that in cash. We owe that and we'll pay that next period. But at this point in time, that's an amount that is owed for services that are provided. Credit $1,500. So that would be an adjusting entry. It's not a business transaction because at that point in time, normally we would not have recorded that. But because we're at the end of the period, and to properly state expenses that are associated with the revenues that we're recording, we must make that adjusting journal entry. So we're I'm gonna just put a little table in here. We're gonna talk about the various entries that we're gonna have. They're gonna fall into 4 groups. So I've created a grid here. And there's going to be 4 different types of adjustments that we're going to make. So I've labeled them, 1, 2, 3, and 4. And again, this is just kind of my arbitrary labeling. But the first one is going to be, and I'm going to be in the upper left quadrant, these are going to be what's called recorded assets that are used up. Okay, so examples of these would be supplies, depreciation would be an example here. And prepaid assets would be another example. So I'm not going to write that in there. Those would be what's called deferred expenses. Okay, deferred expenses being expenses that are put off. So put off expenses, they're recorded assets. They're going to be converted into expenses as they get used up. So they're assets that are going to become expenses as they are used up. So let's take an example of how that would work. So here's an example. We are looking at the supplies account, and we have a beginning balance on January 1st of $2,000. We make a purchase throughout the year on July 15th of $4,500. And at the end of the year, we go in and we count up the supplies that are left, and we determine that there's supplies worth $1,000 that are left. Okay, so I'm going to use T accounts because I think it's helpful to see how the costs come into the supplies account and the the costs that then are used up and what happens to them. So let's look at the supplies account. So on January 1st, the beginning balance was $2,000, and again, this is an asset account, so that would have been a debit in the supplies account. we went ahead and made a purchase during the year. So on July 15th, we would have debited supplies and credited cash or accounts payable. So we would have had an increase in supplies of $4,500. Throughout the year, then, we would have had a total supplies that were available to use of $6,500. At the end of the year, it turns out that on 12/31, we go into the supply storeroom and we count up all the supplies, and it looks like we have $1,000 left over. That's our ending balance. So I think just looking at this visually, we can do some math and we can determine that if we had a total amount that was available to use of 65 and we have 1,000 left, that must mean that we used 5,500. And so what happened was we are going to want to make an adjustment because our supplies balance now should only be 1,000, and we should reflect the fact that 5,500 have been used up and are now going to be reflected as an expense. So our adjustment should look like this, and so this would be our used up portion. So we're going to make an adjustment at 12/31. Our adjusting entry should be $5,500 credit to supplies and a $5,500 debit to supplies expense. So basically at 12/31 then, what we want to do to make sure we record the appropriate amount of expense or supplies that are used up, because we no longer have $6,500, we only have $1,000. We want to make an entry. We want to debit supplies expense for $5,500. We want to credit supplies, the asset, for $5,500. So that would reduce supplies, the asset, down from $6,500 to $1,000, and would reflect the fact that $5,500 was used up, and that's the amount of expense. Because if that was used up, that must mean that those supplies, let's say that that was the paper that was used to put together our brochures, that was used up, that went out the door, that's part of the brochures, that helped us generate revenue. So that expense needs to be recorded in this period and matched against the revenue that we generated. So that would be an example of an asset that's used up, and in this case it's supplies. So we're going to reduce supplies down to what's left over, and the amount that we're reducing it by is the amount that's used up. And used up is basically a code word for expense. And that's the amount that would be transferred to supplies expense via an adjusting journal entry. So again, this is an adjusting entry at 12/31. At the end of the year, we would make that adjusting entry in our books. All right, another example of an asset being used up are long-term assets, fixed assets. That an example would be, say, a machine or equipment or a factory. Those machines are going to be depreciated, and what we're going to do when we talk depreciation is that depreciation is a way of allocating the cost of that asset to expense over its useful life. So in other words, as that machine is being used up, we're going to allocate its cost and match that cost against revenues over the life of the machine. So let's just take an example. Let's say we purchase a machine for $10,000. and its useful life, or the time at which we think it's going to generate revenues, is 5 years. So of course we're going to record in the T account below debit machine, maybe credit cash. So we have a $10,000 machine. Now, at the end of 5 years, we don't want that $10,000 just sitting there. That $10,000 represents a machine that's gradually being used up. Not only that, but if that machine is generating revenues, then there must be some cost associated with those revenues. And the cost is the fact that we paid $10,000 for this machine, and some cost of that machine should be reflected as a revenue, again, as an expense rather, against the revenue it's generating. So what we're going to do is we're going to look at its useful life of 5 years. We paid $10,000, so we're going to take $10,000 and divide that by 5 years. And so we're going to basically allocate $2,000 of this cost to expense each year. So if we look at the example down below, let's say this machine is generating revenues here. Let's just say these are the revenues, and I just made an assumption. The machine, we have to have some expense that's related to that machine. After all, it is a cost that's necessary to generate those revenues. So in year one, we generated $16,000 of revenue. There must be some cost associated with that. And in fact, there is. There's some amount of that machine that's being used up to generate those revenues. And the way we're going to do that is we're going to use depreciation expense as a way of allocating that cost. So in this particular case, we would have depreciation expense of $2,000 that would match against that revenue. Because in fact, that machine was necessary to generate that revenue. So 1/5 of its cost needs to be reflected as an expense that year. And same thing each of the next 4 years. So basically at the end of 5 years, the entire cost of that machine has been allocated as an expense against the revenue that it generated. Okay, so that's the idea. So again, this is the matching principle right here. So we're matching the expense with the revenue that machine generated, and we're reflecting it on the income statement as an expense. So the way we're going to do that is, unlike supplies, our adjusting entry, so let's say at 12/31, we're going to debit depreciation expense. And I'm just abbreviating. You can see the full spelling in the textbook. So depreciation expense at the end of this first year would be $2,000. And of course we could credit the machine for $2,000. The problem is that at some point we're not going to know, if we just looked at the balance sheet, we're not going to know what that machine originally cost, and we're not going to know how much was depreciated. So what we want to do is we want to leave that original cost of the machine intact. So down below, here's our balance sheet each year. Each year, we're going to want to continue to show that, yeah, that machine originally cost $10,000. Okay? We're going to want to show that each year. So we don't want to put the credit against the machine and reduce that. We want the user of the financial statement to always see that, yeah, that machine originally cost $10,000. We're going to want them instead to be able to see how much was depreciated. So we're going to use a separate account called accumulated depreciation, and that's a contra asset account, and it's going to tie itself directly to the machine account. So what we're going to have here is a credit to that accumulated depreciation account for $2,000. So this is like an asset account. It's tied directly to, these accounts are tied directly together, and they show up on the balance sheet together. So that would be that first entry. So now someone reading the financial statements could see that in fact that it's been depreciated $2,000 off the original cost of $10,000, and so forth each year.